Every day in a modern economy, billions of dollars need to move from people who have excess funds to people who need them. The core challenge of capital markets is getting those two groups to connect safely and efficiently at a massive scale. In a market vacuum, we have two primary actors: suppliers of capital, these are everyday investors and savers looking for a return, and users of capital, borrowers, entrepreneurs, and corporations looking to finance growth. If a corporation wants to build a new factory, they can't simply knock on 10,000 individual doors to ask for microloans. Direct peer-to-peer transfers between suppliers and users create enormous logistical friction, and the sheer risk of verifying every single transaction makes it practically impossible. To eliminate that friction, the system relies on a structural bridge, the financial intermediary. Intermediaries pool capital from suppliers and route it to users. They do this by underwriting new securities, distributing those securities to the public, and acting as market makers to guarantee there is always enough liquidity for people to buy and sell. The Canadian securities industry is a highly regulated architecture of these intermediary nodes, explicitly constructed to channel capital while preventing systemic collapse. To understand how this architecture functions, we have to look inside the most critical intermediary in the capital markets, the investment dealer. Investment dealers operate in distinct tiers. Retail firms deal directly with individual investors. They range from full-service brokerages offering comprehensive wealth management to self-directed discount brokers that simply execute trades at lower costs without providing advice. Institutional firms, on the other hand, bypass individual retail investors entirely. They serve high-volume entities like pension funds, mutual funds, and large foreign affiliates trading massive blocks of securities. Finally, integrated firms operate across the entire spectrum. They participate fully in both retail and institutional markets, while actively underwriting all types of government and corporate debt and equity. Because of the heavy regulatory burden placed on them, a large integrated firm separates its operations into three distinct layers: the front, middle, and back offices. The front office handles all direct market interaction. This is where the firm executes portfolio management, active trading, and client sales. It's the engine that generates the firm's profits. But that engine requires a strict control mechanism. The middle office provides the operational framework, housing internal accounting, audits, legal teams, and compliance officers who ensure every trade meets regulatory standards. Below that sits the back office. Once a trade is executed by the front office and verified by the middle, the back office handles the actual settlement and clearing of the securities, moving the digital assets and cash to their final destinations. An investment dealer is a precisely segmented machine. By isolating sales from compliance and trading from settlement, the firm can process totally different types of risk and clientele simultaneously without compromising the integrity of the market. A dealer's risk exposure changes completely depending on how they structure a transaction. Every trade they facilitate is executed using one of two models: as an agent or as a principal. In an agency transaction, the dealer acts as a conduit between two outside parties, never taking ownership of the security. Because their capital is not at risk, the dealer generates profit entirely by charging a commission for executing the trade. A principal transaction operates differently. In a principal transaction, the dealer purchases the security into their own inventory, then independently sells it. Using their own money, they profit from the spread, the difference between the purchase and sale price. By holding the asset, they absorb the market risk. Dealers use this principal model extensively in the primary market. When a company issues new stock, a dealer will act as a principal to underwrite the issue, buying the entire block of new shares with their own capital to sell to the public at a profit. They also use the principal model in the secondary market. Keeping a deep inventory of already issued securities, dealers ensure market liquidity to smooth out volatility. The difference between an agent and a principal is entirely defined by where the capital risk sits at the exact millisecond of the trade. During a single trading day, exchange members act as both buyers and sellers across millions of transactions. If every dealer had to individually settle each distinct trade directly with every other dealer, the logistical weight would crush the system. To solve this, Canada utilizes CDS Clearing and Depository Services, or CDSX. It is a centralized facility that steps between the dealers to manage the daily settlement process. Instead of settling every single trade, the central clearing system uses a mathematical process called netting. If dealer A buys 100 shares from dealer B at 10 a.m. and sells 90 shares back at 2 p.m., the system compiles the sheets and cancels opposing trades. The final outcome of netting is that the massive volume of intraday trading is reduced to a single end-of-day credit or debit balance for each dealer, delivered in either cash or securities. Direct access to this central clearing system is tightly restricted to highly regulated institutional participants, primarily chartered banks, investment dealers, and trust companies. By drastically reducing the sheer number of securities and cash transfers that factually have to change hands, centralized clearing and netting act as the critical shock absorbers of the capital markets, minimizing both transactional friction and counterparty risk. While investment dealers facilitate the markets, the largest financial intermediaries in the country are the chartered banks. All banks in Canada operate strictly under the Federal Bank Act, which dictates exactly how they can hold deposits and originate loans. Under this act, banks are divided into 3 tiers. Schedule 1 banks are domestic, Canadian-owned institutions. For the largest of these banks, voting shares must be widely held. No single individual or group can control more than 20% of the institution. Schedule 2 banks are federally regulated subsidiaries of foreign banks operating within Canada, largely deriving their revenue from retail banking and electronic financial services. Schedule 3 banks are foreign bank branches authorized to operate in Canada, and they tend to bypass the retail market entirely to focus on corporate and institutional finance. Large Canadian banking groups operate vast networks of subsidiaries, managing everything from wealth management and investment dealer activities to the sale of insurance products. Because banks participate across so many diverse financial sectors, regulators mandate strict data barriers between business units. These are known as firewalls. If you open a self-directed investment account through a bank's brokerage subsidiary, the retail bank branch cannot see your trading data. Likewise, the investment dealer cannot access your personal checking account or mortgage balances. Bank schedules and strict data firewalls are designed to ensure that consumer privacy is compartmentalized and that a failure in one specific sector of a massive financial conglomerate does not trigger a systemic collapse across the rest of the institution. Up to this point, the entire Canadian financial system we've examined relies on centralized intermediaries. It requires human advisors, centralized clearinghouses, and strict regulatory oversight to function. But new technologies are beginning to bypass traditional intermediaries. In the front office, we are seeing the rise of Fintech and robo-advisors. Robo-advisors automate the traditional agent role. They bypass human advisors by using modern portfolio theory and goal-based algorithms to automatically build and rebalance retail portfolios, typically using exchange-traded funds. A second, much deeper structural shift is targeting the back office and clearing architecture, the rise of crypto assets and blockchain technology. The Bitcoin blockchain is a decentralized, open-source public ledger. It maintains a permanent, immutable record of balances and validates transactions through a peer-to-peer network, operating entirely outside of central banking control. Instead of relying on a centralized clearinghouse like CDSX to confirm a trade, the blockchain uses public and private keys. These keys provide cryptographic proof of authorization, validating and settling the transfer instantly between the two parties. We now have 2 competing architectures running in parallel. On one side, a system based on the rigid regulatory framework of traditional intermediaries. On the other, a system based on the mathematical, decentralized trust of cryptographic protocols. Mastering the modern Canadian investment marketplace requires understanding exactly how the established regulatory pipeline flows and observing how emerging technologies are attempting to reroute it.